There are moments in history when a headline looks like it is about one thing, but if you look underneath it, the real story is about something much larger. This is one of those moments at first. People may think the story is about oil. The United Arab Emirates leaving OPEC, oil prices rising, gasoline becoming more expensive. The Strait of Hormuz under pressure, the Gulf states asking for dollars. But that is only the surface. The deeper story is about the global monetary system. It is about the petrodollar. It is about why the dollar has had such enormous power for more than half a century. It is about why American financial markets have been supported by foreign demand for us assets. It is about why allies can become creditors and why creditors can become a source of pressure. And it is about what happens when countries that once depended on the dollar begin to build alternatives. That is the important part. When an oil producer says it may use yuan or other currencies if it runs short of dollars. That is not only a payment issue, it is a signal. When the United States says it may provide swap lines to prevent the disorderly sale of us assets. That is not only a liquidity tool, it is an admission. It tells you that the Gulf states hold enough U.S. assets that selling them could create disorder in American markets. That is power. But it is also vulnerability. This is how large systems change, not usually through one dramatic announcement. They change through pressure points. A war exposes a funding problem. A shipping choke point exposes an energy dependency. A reserve manager exposes a trust problem. A bond yield exposes a fiscal constraint. An ally asks for dollars and hints that it may sell assets. A rival offers an alternative currency, trade route, and commodity settlement system. Each piece looks separate, but together they form a pattern. The pattern is that the dollar system is still dominant, but its monopoly power is weakening. That is the framework. Now begin with the event, the United Arab Emirates. One of the founding members of OPEC announced that it would leave the oil cartel and OPEC Plus effective May 1st. That is a major development. OPEC has existed for decades as one of the most important forces in global energy. It coordinates oil-producing countries. It influences supply, it shapes prices, it helps create discipline among exporters. So when a major Gulf producer leaves, you should not treat it as ordinary. The official explanation is that leaving makes it easier for the UAE to meet changing demand. That may be true. Countries act in their own interests. If the UAE wants more production flexibility, OPEC quotas can become restrictive. If it has invested in capacity, it may not want another group deciding how much it can produce, but the timing makes this more important. This is happening while the Iran war has triggered a global energy crisis. Markets are reacting to a supply shock. Gasoline prices are at record highs in the source narrative. The paper price of oil has moved above $100 a barrel. And at exactly this moment, one of America's closest Gulf allies is warning that if it runs short of dollars, it may use yuan or other currencies. That is the real signal for more than 50 years. The basic structure was simple. Oil was sold in dollars. Oil exporters earned dollars. Those dollars were recycled into U.S. financial assets, especially Treasury bonds. The United States provided security. The oil system supported the dollar. The dollar system supported American borrowing. The arrangement worked because each side received something. The United States received structural global demand for dollars and financing for its deficits. The Gulf states received security, weapons, and access to the dollar system. But now the pressure is different. The UAE is saying, in effect, if the war drains our dollar reserves and we cannot get enough dollars, we may start pricing or settling oil in other currencies. We may use yuan. We may sell us assets to raise the dollars we need. That is not a small statement. That is leverage. If a country holds a large amount of your assets and it needs cash, it can sell those assets. If it sells in size, it can destabilize your markets. So when U.S. officials discuss providing dollar swap lines to Gulf allies to maintain order in dollar funding markets and prevent disorderly sales of U.S. assets, the message is clear. The Gulf states have enough U.S. assets to matter. The source says the GCC collectively holds more than $2 trillion in U.S. assets. If that capital were sold suddenly, it could create stress in U.S. markets. So the United States faces a choice: provide dollar liquidity or risk asset sales. This is not simply generosity, it is system management. The United States is trying to preserve order in the dollar system by giving key allies the dollars they need so they do not liquidate American assets. That tells you how the system works. The dollar is powerful because others need it, but when others need it too badly and they own your assets, they can demand support. That is a kind of dependency. Now, the political theater around this can distract people. The source mentions attention turning toward Cuba and the possibility of military pressure there. But the essential issue is not the spectacle. The essential issue is leverage. Who has leverage over whom? The United States has the dollar. The Gulf states have oil and U.S. assets. China has manufacturing, rare earth processing, and a growing alternative trade system. Iran has the ability to pressure the Strait of Hormuz. The bond market has the ability to discipline us foreign policy through yields. This is not one country simply commanding the system. It is a set of interdependent pressures. That is how the world really works. Now, To understand why the UAE leaving OPEC matters, you have to go back to 1971. That was the year President Nixon closed the gold window. Before then, the dollar was linked to gold under the Bretton Woods system. Foreign governments could exchange dollars for gold at a fixed price that gave the dollar a hard anchor. When the gold window closed, the dollar was no longer backed by gold. It became pure fiat money. It was backed by trust, government power, legal tender laws, the tax system, military strength, financial depth, and global acceptance. But if you are an oil-producing country sitting on a finite resource, the question becomes obvious. Why should I sell something real and finite for paper money that can be created in unlimited supply? That is the basic problem the United States had to solve. And the solution was the petrodollar system. In 1974, Secretary of State Henry Kissinger went to Saudi Arabia and helped create the arrangement that would shape the next half-century. Saudi Arabia would price oil in U.S. dollars. Those dollars would be recycled into U.S. Treasury bonds and other U.S. assets. The United States would provide military protection and weapons. The deal gave oil exporters security. It gave the United States a monetary anchor after gold. It created permanent global demand for dollars because every country needed energy. If a country needed oil, it needed dollars. If it needed dollars, it had to trade, borrow, or hold dollars. That is structural demand. This is why the petrodollar system was so powerful. The dollar was no longer backed by gold, but it was effectively backed by the world's need for oil. That does not mean every barrel of oil was part of one simple written contract. It means the global system was organized around the dollar as the energy settlement currency. OPEC became an important part of that order. OPEC managed supply. It coordinated oil producers. It maintained enough discipline among exporters to keep oil prices and dollar-denominated oil trade within the broader system. In a world where the reserve currency has no hard backing, oil discipline matters. Because if the dollar is pure fiat and can be printed, oil producers need a reason to keep accepting it. The reason was not only economic, it was geopolitical security, arms market access, dollar liquidity, treasury recycling. That was the bargain. Now the bargain is under stress. The source describes the 50-year petrodollar arrangement expiring in 2024. Whether the legal form is debated or not, the deeper point is clear. The old unquestioned assumption that Gulf oil must remain locked to the dollar is weakening. Then the Iran war begins. That creates the shock. The Strait of Hormuz becomes the center of the system. Hormuz handles a huge share of the world's oil and gas flows each day. Saudi Arabia, the UAE, Kuwait, Qatar, and Iraq depend on access through or around that route to move energy to world markets. If Hormuz is closed, even partially, the Gulf economic model breaks down quickly. Oil exporters may have oil underground, but they cannot monetize it efficiently if they cannot export it. That means less dollar revenue. Less dollar revenue means pressure on dollar reserves. Pressure on dollar reserves means pressure on currency pegs. Many Gulf currencies are pegged to the dollar. A peg requires confidence in dollar reserves. If reserves fall too far, markets begin to question the peg. Defending a peg requires dollars. So the Gulf states need dollar liquidity at exactly the moment their oil export revenues are under pressure. This is why the swap lines matter. The war does not only create a military problem, it creates a dollar funding problem. Saudi Arabia is a good example in the source before the war. Saudi Arabia needed oil around $100 per barrel to cover government spending, imports, and social programs. If export volume falls because Hormuz is constrained, the price required to generate the same revenue rises sharply. The source cites an estimate around $170 per barrel. But oil is not $170, the paper price is lower. So Saudi Arabia may be forced to borrow externally to cover the gap. The source says external borrowing has reached more than $100 billion over the trailing 4 quarters. A historically extreme level for the kingdom. Think about what that means. The world's largest oil exporter is borrowing dollars to survive a dollar liquidity squeeze caused by a war and an energy choke point. That is an enormous reversal. Oil exporters once supplied dollars back into the U.S. system through Treasury purchases. Now they may need dollars from the U.S. system to prevent financial stress. That is how the petrodollar machine begins to invert. Now ask the deeper question, what does an ally do when the United States starts a war in its region? Oil flows are disrupted, dollar reserves are drained, and the paper price of oil is held below what fiscal systems require. It asks for dollars. And if it has leverage, it reminds the United States that it owns assets it could sell. That is the logic behind the UAE warning. It is not only a complaint, it is a negotiation. The UAE strengthens ties with China. It signals willingness to use yuan. It leaves OPEC. It asks for dollar liquidity. It uses both sides. That is how a smaller state gains leverage in a multipolar world. Now look at the timeline from the source. On the 14th of April, the UAE Crown Prince meets with Xi Jinping in China. On the 15th of April, the UAE and China signed 24 trade and investment deals with the goal of pushing trade above $100 billion. On the 19th of April, the yuan warning appears. On the 22nd of April, U.S. officials support the idea of swap lines. On the 28th of April, the UAE announces it is leaving OPEC. That sequence matters. The UAE deepens the China relationship first. Then it signals to Washington that it has alternatives. Then it receives consideration for dollar liquidity. Then it exits the cartel structure. This is bargaining power. China is not winning because it fires the most dramatic shot. China is winning because it has spent years building the real economy and the alternative plumbing ports. Mines, rare earth processing, payment systems, yuan clearing banks, commodity settlement channels, long-term trade relationships. You do not build that in a crisis. You build it before the crisis, and then the crisis reveals its value. That is one of the main principles of geopolitical competition. Preparation matters more than speeches. China has prepared. The United States has relied heavily on the financial power of the dollar. Financial power is real, but it is not a perfect substitute for industrial capacity. You cannot fight a war with paper assets. You need missiles, interceptors, rare earths, tungsten, precision manufacturing, supply chains, and production capacity. The source argues that the United States may be extending ceasefire pauses not only for diplomacy, but because missile stockpiles and critical materials are under pressure. It notes that the U.S. military has depleted key missile stockpiles and cannot replace them quickly, while China controls a major share of rare earth mining and processing. Whether every number is exact is not the important point for the framework. The important point is the asymmetry. The United States controls the dominant financial system. China controls large parts of the manufacturing and critical materials supply chain. In a financial war, the United States can freeze reserves, sanction banks, restrict access to dollars, and pressure allies. In a real resource war, China can restrict rare earths, control processing, build trade alternatives, and create dependencies. Both sides have leverage, but the world is starting to learn that financial leverage alone is not enough if the industrial base is weak. That is the deeper message for 50 years. The United States acted as if printing dollars and recycling them through financial markets could replace making enough of the physical things that matter. China made the things. It built the supply chains, it bought mines, it processed critical materials, it built alternative payments infrastructure, it waited. Now, during a crisis, those real assets matter. That is why the dollar system is under pressure. Now, what does this mean for the dollar? It does not mean the dollar disappears tomorrow. That is a childish way to think. Reserve currencies do not collapse in one headline. They lose share gradually. They lose trust at the margins. They remain dominant long after the peak. The dollar is still the largest reserve currency. It is still the primary funding currency of the world. U.S. markets remain deep. The Treasury market remains central. The U.S. still has extraordinary power, but the trend has changed. In 2001, the dollar made up about 72% of global foreign exchange reserves. Today, that share is in the 50s. Still the largest, no longer a monopoly. That difference matters. A reserve currency can remain dominant and still be declining. The question is what replaces the lost share. It is not one currency, it is a mixture: gold, other currencies, regional settlement systems, yuan channels, commodity, linked structures, alternative payment rails. The most important replacement in the source is gold. Central banks have been buying gold at the fastest pace in decades. Gold has become a larger share of reserves on an adjusted basis than Treasury bonds in the source. Framing: why would the most conservative institutions in the world buy gold instead of U.S. government debt? Because gold has no counterparty. A Treasury bond is someone else's liability. A dollar reserve is inside a political and banking system. Gold is not. After the United States and its allies froze Russian foreign exchange reserves in 2022, every central bank in the world learned the same lesson. Reserves are not purely financial assets. They are political exposures. If you hold reserves in dollars and treasuries, you are holding them inside a system that the United States can weaponize. That does not mean every country abandons the dollar. It means every country asks how much dependence is safe. That question leads to diversification, and diversification leads to gold. Gold does not pay interest. Gold does not generate earnings. Gold is not a productive business. But gold is outside the liability structure of governments. That makes it valuable when trust in government liabilities declines. This is not a gold bug fantasy. It is reserve management. Central banks are not buying gold because they saw a dramatic video. They are buying because the world has changed. Sanctions risk rose, debt levels rose, fiscal deficits rose, geopolitical fragmentation rose, trust in foreign custody fell, so gold became more attractive. That is the signal. Now, China has also been building alternative financial plumbing. Yuan clearing banks now operate in major financial centers such as London, Dubai, Singapore, Hong Kong, and Switzerland. Commodity deals are being settled or discussed in yuan. BHP, one of the world's major mining companies, signed a deal shifting commodity sales toward yuan-based pricing with a Chinese state buyer in the source narrative. Iran has sold oil to China in yuan for years. India has experimented with alternative payments. Russia, after sanctions, has moved away from the dollar wherever possible. The alternative system is not complete. It is not as deep as the dollar system, it is not as liquid, it is not as trusted globally, but it exists. And in a crisis, the existence of an alternative matters. You do not need a full replacement to weaken a monopoly. You only need credible alternatives at the margin. That is how reserve systems change, not in a straight line through marginal shifts. Now, because trust in treasuries has weakened, investors demand more compensation. They may still buy us debt, but they want higher yields. That is why the 10-year treasury yield becomes so important. The source highlights the 4.4% level as a pressure point. Every time the 10-year yield approaches that level, the bond market begins pressuring policymakers. This is a profound observation. The bond market can discipline foreign policy. If a military escalation causes investors to demand higher yields, the U.S. government's borrowing costs rise. If borrowing costs rise too much, the treasury market can become unstable. If the treasury market becomes unstable, the whole financial system is threatened because treasuries are the foundation of global collateral and dollar funding. So the government must watch the bond market when yields rise toward a pain threshold. Leaders may soften rhetoric, extend ceasefires, or pause military actions. That is what it means to say the bond market is running foreign policy. It is not that bond traders sit in the situation room. It is that the U.S. fiscal position is so large and so interest rate sensitive that foreign policy choices can be constrained by treasury yields. That is the logic. A heavily indebted empire has less freedom of action than it believes. Debt is not only a financial number, debt becomes a strategic constraint. Now, the swap lines to Gulf states may stabilize dollar funding in the short run. They give allies access to dollars. They help prevent forced selling of us assets. They maintain order, but if Hormuz remains constrained, this liquidity can create a bigger problem later. More dollars entering the system can support bonds temporarily. But if energy supply remains restricted, the extra liquidity can push commodity inflation higher. Higher commodity inflation makes investors demand even more compensation to hold bonds. Because if inflation rises, the real value of fixed payments falls. Bondholders do not want to be repaid in money that buys less. So they demand higher yields. That creates the loop. War creates energy pressure creates inflation pressures bonds, bond pressure constrains policy, dollar liquidity buys time. But if the supply problem remains, liquidity can worsen inflation. That is the trap. Short-term stability can create longer-term instability. This is a classic policy trade-off. Governments often choose the immediate relief because the immediate crisis is visible. The future cost is less visible, but the future cost still arrives. Now, Iran understands this. Iran may not be able to defeat the United States militarily in a conventional sense, but the war being fought is not purely military, it is economic. If Hormuz remains constrained, the Gulf states lose revenue, energy prices rise, food costs rise, fertilizer trade is affected, inflation spreads, bond markets revolt. The United States faces higher borrowing costs, allies demand support, China buys energy and builds alternative settlement systems. This is an economic war of choke points, reserves, commodities, and interest rates. That is why it is so dangerous. Now, how does it end? The source gives two paths, and both are bad. One path is that Iran collapses. If that happens, Iranian oil may go offline for a long time. That can cause an oil spike. An oil spike can trigger a global recession. It can hit bond markets that are already fragile. The other path is that the global supply chain breaks before Iran does. If Hormuz remains closed or severely constrained, global inflation rises, energy costs rise, fertilizer costs rise, food inflation rises. The supply chain absorbs the shock, bond markets respond, recession risk rises. In both paths, the market's assumption of a quick and clean resolution may be wrong. That matters because asset prices today are not priced for deep, prolonged disruption. They are pricing something closer to perfection. They are pricing an AI productivity boom. They are pricing a fast end to the Iran war. They are pricing manageable bond yields. They are pricing enough liquidity to prevent crisis. If any of those assumptions fail, valuations can change quickly. That is the investment implication. Now, the fertilizer issue is especially important. The Strait of Hormuz does not only matter for oil, it also matters for fertilizer trade. The source notes that Hormuz handles roughly 1/3 of global fertilizer trade, and that synthetic nitrogen fertilizers support billions of people beyond what the planet could feed without them. If fertilizer flows are constrained, the impact may not show up immediately at the grocery store, but it can reach food prices with a lag. Energy affects fertilizer. Fertilizer affects food. Food affects inflation. Inflation affects bond yields. Bond yields affect the stock market. That is the chain. Most people look at gasoline prices and stop there. They do not see the second-order effects. But second-order effects are what drive big macro outcomes. Food inflation is politically dangerous because everyone eats. It is not a luxury sector. It affects poor households most intensely. If food inflation rises while wages lag, social pressure rises, central banks become trapped. Governments become unstable. This is why Hormuz is not only an energy story, it is a food and inflation story. Now consider the valuation of the stock market. The source references a version of the Buffett indicator adjusted for federal debt. The classic Buffett indicator compares total stock market value to GDP. It asks whether the market is large relative to the economy, but in a world of large federal debt and money creation, the adjusted version subtracts federal debt from GDP, creating a different view of overvaluation. According to the source, this adjusted metric has only been above 100% of GDP 3 times in the last 70 years. The dot-com bubble peak in 2000, the everything bubble peak in 2021, and now in the prior 2 cases, markets fell between 25 and 47% from peak to bottom and took between 2 and 13 years to recover. That does not mean the future must repeat exactly, but it means the market is at a dangerous valuation zone under that framework. And both prior periods were very favorable for gold relative to stocks. That is important. If stocks are pricing perfection and the macro system is fragile, a prudent investor should not ignore defensive assets. Gold becomes important because it tends to benefit when trust in financial assets, currencies, or government debt weakens. Cash becomes important because it gives optionality. It lets you survive volatility. It lets you buy when others are forced to sell. But cash also has inflation risk, so the balance matters. Holding more cash than usual can make sense in a fragile environment. But holding only cash can be dangerous if inflation accelerates. Gold can hedge certain monetary and geopolitical risks, but it can be volatile and does not produce income. Stocks can compound over time, but they may be overvalued and vulnerable to shocks. There is no perfect asset. The goal is not perfection. The goal is resilience. Now, what does this mean for portfolios? It means investors should not be complacent. The market may continue rising. AI may continue driving productivity expectations. Liquidity may remain supportive. A ceasefire may hold. Hormuz may reopen. Oil may fall. Bond yields may stabilize. In that case, risk assets can continue higher, but the downside scenario is not small. If Hormuz remains constrained, if food inflation accelerates, if Gulf states continue pressuring the dollar system, if China deepens yuan commodity settlement, if Treasury yields break higher, if gold continues replacing treasuries in reserve portfolios, then the market's current assumptions may be wrong. When assumptions change, prices change. That is how markets work. The price is not truth. It is a probability-weighted expression of assumptions. Change the assumptions and the price must adjust. Today, the source argues that investors are too optimistic. They are assuming a fast end to the war and a smooth AI boom. If those assumptions fail, the market could reprice significantly. So a cautious stance is reasonable, not panic. Caution, there is a big difference. Panic sells everything emotionally. Caution holds liquidity, diversifies, owns hedges, avoids overconcentration, and understands the risks. The source says the speaker holds more cash than usual but remains invested. That is a reasonable framework. You do not need to be all in or all out in a fragile macro environment. A barbell can make sense. Some exposure to productive assets because you do not know if markets will keep rising, some cash because you may need optionality, some gold or real assets because monetary trust is weakening, some energy exposure may be considered by those who understand it because energy supply shocks can benefit energy assets while hurting the broad market. But every position has risk. Oil can reverse, gold can correct, cash can lose purchasing power, stocks can crash. Bitcoin can be highly volatile. There is no asset that solves every scenario. So the portfolio should be built around scenario resilience. If inflation rises, what helps? If recession arrives, what helps? If bond yields spike, what hurts? If the dollar weakens, what helps? If risk assets fall, what liquidity do I have? If the AI boom continues, what exposure do I keep? This is how you think, not by predicting only one future, by preparing for several. Now, let us return to the dollar. The dollar's greatest strength has been that everyone needed it. Energy trade required it, debt was issued in it, reserves were held in it, global banks funded in it, treasuries were the safest collateral. That network effect is enormous. But network effects can erode if trust changes and alternatives grow. The freezing of Russian reserves told every country that dollar reserves can be weaponized. The Gulf dollar shortage tells every country that dollar access can become a strategic bargaining point. China's yuan settlement and commodity deals tell every country that alternatives are no longer theoretical. Gold buying tells every country that central banks are hedging. The UAE leaving OPEC tells every country that old oil discipline is weakening. These signals do not end the dollar system tomorrow, but they reduce confidence in its permanence. That is how reserve currencies decline. First slowly, then more visibly, the British pound did not disappear in one day. It lost share as the empire weakened and the US rose. The dollar may follow a long, uneven path where it remains important but less dominant. That is enough to change portfolios. A world where the dollar is dominant but declining is not the same as a world where the dollar is uncontested. The first requires diversification. The second allowed concentration. That is the transition. Now, what are the assets most directly affected? Gas prices are affected by oil supply and refining conditions. Gold is affected by reserve diversification, real yields, inflation, and trust in government liabilities. Bitcoin may be affected by dollar debasement narratives, liquidity, and risk appetite, though it behaves differently from gold and can fall sharply in risk-off environments. The US dollar is affected by reserve demand, trade settlement, treasury demand, and relative interest rates. Treasury bonds are affected by inflation expectations, foreign demand, deficits, and bond market confidence. Stocks are affected by earnings, interest rates, liquidity, valuation, and macro shocks. Energy stocks may be affected by oil prices, geopolitical risk, and supply constraints. Defense stocks may be affected by war spending, but also by supply chain constraints and political decisions. International assets may become more relevant if dollar dominance weakens, though they carry their own risks. This is not a simple one, asset answer. It is a system answer. Now, the source S-core warning is that the U.S. market may be pricing perfection. That is dangerous when the background system is fragile. If valuations are high, the margin of safety is low. If the bond market is sensitive, policy freedom is low. If energy is disrupted, inflation risk is high. If foreign reserve managers prefer gold, treasury demand may be less reliable. If Gulf states can threaten asset sales, dollar liquidity must be provided. If China controls key inputs, U.S. military and industrial strategy is constrained. All of these create a less forgiving environment. In a forgiving environment, markets can absorb mistakes. In an unforgiving environment, small shocks become large. That is where we may be. Now, how should an ordinary investor respond without becoming extreme? First, understand that being invested and being cautious can coexist. You can hold broad market exposure and still raise cash. You can own stocks and still own gold. You can believe in long-term American innovation and still recognize valuation risk. You can respect the dollar's dominance and still hedge against its decline. You can benefit from the AI boom and still worry about geopolitical supply shocks. The mind must hold more than one truth. Second, reduce leverage. Leverage is dangerous in uncertain macro environments. If volatility rises, leverage can force selling at bad prices. Third, maintain liquidity. Cash is not exciting, but it gives you the ability to respond. It helps you avoid selling long-term assets during panic. Fourth, consider assets that benefit from monetary and geopolitical stress. Gold is the most obvious in the source framework. Energy exposure may also play a role, but it is more cyclical and requires care. Fifth, do not chase every move. If oil spikes, buying after panic may be dangerous. If gold runs, entry matters. If stocks fall, some declines are opportunities and some are warnings. Use a system. Sixth, watch the 10-year Treasury yield. If yields rise sharply, that is not only a bond story, it affects mortgage rates, stock valuations, government interest costs, and foreign policy constraints. Seventh, watch Hormuz and fertilizer. Oil is the first-order shock. Fertilizer and food are second-order shocks. Eighth, watch Gulf dollar funding. If Gulf states need swap lines, the dollar system is under stress in a very specific way. Ninth, watch gold reserves. Central bank buying is a structural signal. 10th, watch yuan commodity settlement, not because the yuan replaces the dollar immediately, but because every marginal shift weakens the monopoly. This is the framework. Now, the final lesson is about power. Power is not only military, power is also monetary. Power is also industrial. Power is also supply chain control. Power is also reserve currency status. Power is also the ability to force others to hold your liabilities. For decades, the United States had extraordinary financial power because the world needed dollars and treasuries. But if the world begins to need fewer dollars, hold more gold, settle more trade in yuan, and demand higher yields to hold us debt, then American power changes. It does not disappear. It changes. A system that was once enforced by oil, OPEC, treasuries, and U.S. security guarantees is now being renegotiated under stress. The UAE leaving OPEC is one piece, the yuan warning is another. The swap lines are another, Hormuz is another, China's rare earth leverage is another, central bank gold buying is another. The 10-year yield is another. These are not separate stories. They are signs of a monetary order being contested. That is why the petrodollar story matters. Not because the dollar ends tomorrow, because the structure that made the dollar unquestioned is no longer unquestioned. That is the shift, and investors must respect shifts before they become obvious. When something is obvious, it is often priced. When something is still developing, there is time to prepare. The preparation is not panic, it is balance. Own assets, hold liquidity, respect gold, watch energy. Do not ignore inflation. Do not assume treasury markets can absorb everything forever. Do not assume allies will remain passive if their own monetary systems are threatened. Do not assume China has not prepared alternatives. Do not assume the stock market can price perfection indefinitely. And do not assume the dollar's past dominance guarantees the same future. The world is changing, slowly in some places, quickly in others. But the direction is clear enough to study. The end of the petrodollar is not one event. It is a process. A process in which oil producers demand more flexibility. A process in which China offers alternatives. A process in which central banks buy gold. A process in which Treasury buyers demand higher yields. A process in which the United States must supply dollars to prevent allies from selling its assets. A process in which the bond market constrains geopolitical action. A process in which energy and food inflation threaten domestic stability. That is the real story. And the investor who understands the process will be less surprised by what comes next. Not because they can predict every headline, but because they understand the machine. In markets and geopolitics, understanding the machine is the only way to stay rational when the headlines become chaotic. That is what matters. Now, the UAE leaving OPEC is not just about oil. It is about the dollar. It is about reserves. It is about gold. It is about China. It is about the bond market. It is about whether the United States can continue financing itself on the same terms as before, and it is about whether portfolios built for the old world are ready for the new one. That is the question every investor should be asking.